Taxes are going up. Now, how do I feel so confident making that statement? Well, it's really just a matter of demographics and math. Each year, the Congressional Budget Office puts out a report that tracks every dollar the government takes in as revenue and every dollar that the government spends as an expenditure. And when we look at this report, a very concerning story starts to emerge. In the last fiscal year, our government took in $4.4 trillion of revenue through taxes and fees, primarily through individual income taxes. Now, $4.4 trillion is a lot of money, unless, of course, the government is spending more than $4.4 trillion. And this is where the story gets interesting and important to U.S. savers. On the spending side, the first place that our government spends money is on mandatory spending. Mandatory spending is spending that is not controlled by Congress or the president. It is spending that is codified into current law, what the government owes its citizens. Now, in mandatory spending alone in the last fiscal year, the primary drivers of that spending were Social Security and Medicare. That, along with things like service on the national debt, drove us to about $4.4 trillion in mandatory spending. So the government took in $4.4 trillion, and before Congress even met, before a single bill was passed or the president introduced a single budget priority, every dollar it had taken in was already spent on mandatory programs. Now, of course, Congress did spend money to the tune of about $1.7 trillion. And of course, it's easy to say Congress spends too much money, but some of that spending is on things that we do need. Defense and military spending is included in that congressional spending, as are bridges, roads, transportation, and infrastructure. So Congress is going to have to spend some money, but right now, in the last fiscal year, every dollar Congress spent was deficit spending. Altogether, our government spent about $6.1 trillion in the last fiscal year. Now, if you've completed third grade math and you know subtraction, you can imagine that if we take in $4.4 trillion and we're spending $6.1 trillion, we are left with about a $1.7 trillion gap. And that gap is the federal deficit. It's the difference between the revenue that the government takes in and the revenue that the government spends. That gap, the CBO projects over the next 10 years, will never be lower than it was in the last fiscal year. So it's always going to be over $1.7 trillion. Now, it's not the equation itself that is driving risk of rising taxes for savers like you and me. It's the challenge that we're going to face as a nation for doing anything about it. I mentioned that the two largest drivers of mandatory spending are Social Security and Medicare. In America today, we have an aging population. We have more people requiring Social Security and Medicare than at any time in the last 100 years. And that means that mandatory spending is not going to be able to be shrunk. In fact, it is projected to grow exponentially. So if we can't reduce mandatory spending, which is the largest bit of spending that we do, and we know that Congress can't get its spending down to zero because we'll always need a military and roads and different priorities, then the only piece of this equation that we can really affect is to generate more revenue. And over half of federal revenue comes from the individual income taxes that you and I pay each year. This is why I and many experts believe long-term we are entering into a rising tax environment. And that means for savers like you who have saved in a 401k or an IRA, any of these vehicles where we have deferred paying taxes to the future in retirement, we need to start paying attention. When we started saving in 401ks and IRAs, the promise was that taxes would be lower in retirement than they are today. But because of these budgetary pressures coming out of Washington, there's a very real chance that at some point in retirement, your taxes could be higher than they are today. And we have to make sure that you're prepared. Retirement is all about looking at the risks on the horizon and making sure that our retirement approach is protected if things don't go as planned. Well, we absolutely have to apply that thinking when it comes to taxes. If taxes in retirement are higher than you planned, it means you'll be sending more of your check to the IRS in Washington in the form of taxes, leaving you less money to live on as income in retirement. If taxes rise in the future, will your retirement approach still be okay? That is probably the key analysis that you and your financial professional need to evaluate this year. We know that over the long term, taxes are going up, and we know that retirement is a long-term proposition. It's not about what's going to happen in Washington over the next 2 to 4 years with the new administration and the new House and Senate. It's about what is going to happen decades into the future as you're in retirement, trying to access your retirement income that you have worked so hard to save. So if you put one priority for yourself this year, make sure that you understand the potential tax bill you have coming in retirement in your 401k or in your IRA. And if there are options that you might want to consider to reduce that tax bill, to buy out the IRS from a portion of your retirement account through something like a Roth conversion, so that you have a better hedge and better protection against the risk of rising taxes. We know the demographic path that our country is on. We know the mathematical reality that our government is going to need to spend dramatically more than it takes in. That leads me to believe higher taxes are coming, and we need to be prepared.